In 2007, I sat across from a 62-year-old man in our Oak Tree offices. He had $480,000 saved. He was proud of that number, and he should have been. He'd worked hard, saved consistently, done everything the financial advisors told him to do. He had his money in a balanced portfolio, 60% stocks, 40% bonds, just like the textbook said. He was planning to retire in 2009, 2 years away from freedom. See, I remember the conversation because of what I didn't say. I didn't tell him that I thought we were late in the cycle. I didn't tell him that credit spreads were tighter than I'd seen in decades. I didn't tell him that our firm was sitting on record amounts of cash because we couldn't find opportunities that adequately compensated us for risk. I didn't say these things because he wasn't our client and I wasn't his advisor. He was just someone who'd read my memos and wanted to meet me. 18 months later, his $480,000 was worth $290,000. He didn't retire in 2009. He worked until 2015. He's fine now, but those 6 extra years of work, that wasn't the plan. That wasn't what he'd earned through decades of discipline. I think about him often, not because his story is unique. It's not. Millions of people lived that exact experience. I think about him because of the principle he didn't understand. A principle that would have changed everything. A principle that matters more at 60 than at any other age. Let me show you what that principle was and why it's more relevant right now than it's been since 2007. Before I continue, I need to know who I'm talking to. Drop your age and current savings in the comments. No judgment, just context, because what I'm about to share applies differently depending on where you stand. And if you're over 60 with under $500,000 saved, subscribe now. This channel isn't about hot stock tips or get-rich-quick schemes. It's about risk management and cycle awareness. The kind of thinking that protects wealth when protection matters most. In the next few minutes, I'm going to show you 5 principles that most people learn too late. The first one alone could save you a decade of unnecessary work. But you have to stay until the end, because the most important insight comes at the 12-minute mark. Let me start with what most people get wrong about retirement planning after 60. They think it's about returns. They've been taught to focus on portfolio growth. Every financial calculator tells them they need 7% annual returns to make their plan work. Every advisor shows them historical averages and says, see, the market returns 10% long-term. But here's what 5 decades of investing actually shows. After 60, with under $500,000, it's not about returns at all. It's about sequence. The order in which returns happen matters more than the returns themselves. This isn't opinion. This is mathematics. And it's the single most important concept that the man in my office didn't understand in 2007. I'm going to break this down into 5 principles. Each one builds on the last. Miss one, and you're vulnerable. Master all 5, and you'll navigate the next 20 years with confidence that most people your age don't have. Let's start with the principle that changes everything. The first thing you need to understand is this. Your money has entered a different phase. Not because you turned 60, but because your time horizon changed. When you're 30, with $100,000, you have 35 years until retirement. A market crash, painful, but you recover. You keep contributing. You buy at lower prices. Time is your ally. At 60 with $400,000, you have maybe 5 to 10 years of peak earning and saving left. Then you switch from accumulation to distribution. You go from adding money every month to withdrawing it. This flip changes everything about how you should think about risk. Here's what most people do. They keep the same investment approach they had at 40. They stay aggressive because they've been taught that time in the market beats timing the market. They maintain 70% or 80% stock exposure because historical averages say that's optimal. But they're wrong, and here's why. That advice assumes you're still accumulating. It assumes bad years early don't matter because you're buying at lower prices. It assumes you have decades to recover. You don't have decades, you have years, maybe 10 good ones. And if those 10 years include a major bear market early, especially in your first 5 years of retirement, the mathematics become brutal. Let me show you this principle in action. In 1999, 2 people retired. Same age, 62, same savings, $500,000, same withdrawal rate, 4% annually adjusted for inflation, same portfolio, 60% stocks, 40% bonds. Person A retired in January 1999. Person B retired in January 2003, just 4 years apart. Person A experienced the dot-com crash immediately. Their portfolio dropped 30% in their first 3 years of retirement while they were withdrawing money. Person B experienced 4 good years first, then the same crash, but they'd built a cushion. By 2010, person A had $310,000 left. Person B had $520,000. Same strategy, same markets eventually. Different sequence. Person A's money lasted 22 years. Person B's money lasted 34 years. The difference between running out at 84 and having money at 96. This is called sequence of returns risk, and it's the most important concept in retirement planning that almost nobody explains properly. At Oaktree, we think about this constantly, not for retirement portfolios specifically, but for the same underlying principle. When you're distributing capital rather than accumulating it, defensive positioning in late cycle environments isn't optional, it's essential. In 2005 and 2006, when credit spreads were tight and everyone was leveraging up, we sat on cash. Our investors questioned us. We were missing the rally. Other distressed debt firms were showing better returns. But we understood where we were in the cycle. We knew that preservation mattered more than participation in the late stages. When 2008 came, we had $11 billion in dry powder. We deployed it at prices we'd been waiting years to see. Not because we predicted the crisis, but because we respected the cycle and positioned defensively when defense was appropriate. That's what you need to do now if you're over 60, with under $500,000. Not because I'm predicting a crash, I don't predict, but because defensive positioning when you're in the distribution phase of life is simply prudent risk management. Now here's the second level thinking. First level thinking says, I need growth, so I need stocks. Second level thinking asks, what happens if I get a bear market in my first 5 years of retirement? And when you ask that question, you realize that protecting against that scenario matters more than maximizing returns in a continued bull market. This is what separates people who run out of money at 82 from people who leave an inheritance at 92. Not intelligence, not information, thinking process. So what do you actually do? If you're 60 to 65 and still working, build a cash reserve equal to 3 to 5 years of planned retirement expenses. Not in your 401k, separate, accessible. This reserve lets you avoid selling stocks in a down market early in retirement. If you retire into a bear market, you live off cash for 2 or 3 years while stocks recover. This single decision can add a decade to your portfolio's life. If you're already retired, consider reducing equity exposure to 40% to 50% if you're above that. Yes, you might miss some upside if markets continue rising, but you're protecting against the scenario that destroys retirement plans. The math favors defense when you're withdrawing. But that principle alone isn't enough, because there's a hidden risk that compounds with sequence risk, which brings us to the next principle. The evidence for this principle is overwhelming. After tracking thousands of retirement outcomes over 40 years, the pattern is undeniable. Flexibility matters more than any other factor. Here's what I mean. You've probably heard of the 4% rule. Withdraw 4% of your portfolio in year 1, adjust for inflation each year, and your money should last 30 years. It's based on historical analysis. It's taught everywhere, but it's dangerous if applied rigidly, because it assumes you'll withdraw the same amount regardless of market conditions. It assumes you're inflexible. Think about what that means. If you retired in 2000 with $500,000 and followed the 4% rule, you withdrew $20,000 in year 1, then $20,600 in year 2, adjusted for inflation, then $21,200 in year 3. Even though your portfolio had dropped from $500,000 to $350,000 by year 3 because of the dot-com crash. You're withdrawing more dollars from a smaller portfolio. The mathematics are brutal. You're selling more shares each year to generate the same income. You're accelerating depletion. The investors who survived that period with their retirement intact were the ones who adjusted. They cut spending by 10% or 15% in the bad years. They took part-time work. They delayed Social Security. They were flexible. This is where conventional wisdom fails. Financial planning assumes steady withdrawals. But markets aren't steady. Life isn't steady. The ability to reduce spending by 20% for 2 years during a crisis is worth more than an extra 1% return in normal years. At Oaktree, we've built our entire investment approach on this principle of flexibility. We don't have to invest. We can wait. We can sit on cash for years if we don't find opportunities that adequately compensate us for risk. That flexibility is our greatest advantage. You need the same flexibility in retirement, not the ability to live on 20% less forever, but the ability to reduce spending temporarily during market stress. The retirees who maintain their lifestyle no matter what are the ones who run out of money. The retirees who adjust to conditions are the ones who preserve wealth. This leads to an important question. How do you build flexibility into a retirement plan? First, distinguish between fixed and flexible expenses. Fixed, housing, insurance, basic food, utilities, healthcare. Flexible, travel, dining out, gifts, hobbies, discretionary purchases. Your fixed expenses should be covered by guaranteed income, Social Security, pensions, annuities. Your flexible expenses come from portfolio withdrawals. If your fixed expenses exceed your guaranteed income, you're vulnerable. Any market decline forces you to sell stocks to pay non-negotiable bills. But if your guaranteed income covers fixed expenses, you have options. Markets down 30%? Cut flexible spending for a year or two. Let the portfolio recover. Resume normal spending when conditions improve. Second, delay Social Security if you can. Every year you delay from 62 to 70 increases your benefit by roughly 7% to 8%. That's a guaranteed, inflation-adjusted return. If you're 62 with $400,000 saved and in good health, working 2 or 3 more years and delaying Social Security until 65 or 66 is often the highest return decision you can make. You're adding to savings, letting existing savings compound, and increasing guaranteed lifetime income. Third, maintain skills and relationships that allow part-time work. I'm not talking about working until you drop. I'm talking about the ability to generate $15,000 or $20,000 a year if needed during a market crisis. Consulting, part-time work in your field, teaching. The optionality alone reduces stress and extends portfolio longevity. This isn't sexy, this isn't exciting, but it works. And working is better than exciting when you're managing the most critical financial phase of your life. Stay with me, because this next part is crucial. The third principle builds on the first two and addresses something most people discover too late. This principle is the most important for anyone over 60. Healthcare costs will be larger than you think. Not a little larger, dramatically larger. The average couple retiring at 65 will spend $315,000 on healthcare over their retirement. That's Fidelity's estimate from 2023. It doesn't include long-term care. Just Medicare premiums, supplemental insurance, co-pays, prescriptions, dental, vision, the basics. And here's the pattern I've observed over decades. People consistently underestimate this by 50% or more. They plan for $150,000. They spend $300,000. The difference destroys retirement plans. I see this constantly. Someone retires at 62 with $450,000. They think they're fine. They've calculated 4% withdrawals, $18,000 a year plus Social Security. They've accounted for inflation, but they've allocated $100,000 total for healthcare over 30 years. By age 75, they've already spent $120,000. By 80, they're at $200,000. Their plan is failing, not because markets crashed, but because they underestimated a predictable expense. The investors who understood this principle planned differently. They treated healthcare as a separate category. They contributed maximum amounts to HSAs while working. They researched Medicare supplement options before retiring. They built specific healthcare reserves. This is second-level thinking in action. First-level thinking says, I'll have Medicare, I'll be fine. Second-level thinking asks, what does Medicare actually cover, and what will I pay out of pocket? And when you ask that question, you realize Medicare covers roughly 60% of healthcare costs. You're responsible for the other 40%. Over 25 years, that's significant. So what do you actually do? If you're still working and have access to an HSA, maximize contributions. It's triple tax advantage. Tax deductible going in, grows tax-free. Withdrawals for medical expenses are tax-free. It's the best retirement account that exists. But only 5% of eligible people max it out. Research Medicare supplement plans before you turn 65. Not at 65, before. Understand the difference between Medigap and Medicare Advantage. Understand what each costs and covers. The decisions you make at 65 lock in for years. Make them informed. Consider long-term care insurance if you can afford it, or plan to self-insure with specific assets designated for that purpose. Roughly 70% of people over 65 will need some form of long-term care. The average cost is $100,000 to $200,000. Medicare doesn't cover it. This expense alone can devastate a $400,000 portfolio. Build a separate healthcare reserve if possible. Even $50,000 designated specifically for medical expenses provides enormous peace of mind and protects your investment portfolio from forced liquidations. But here's where it gets interesting. These first three principles, sequence risk, flexibility, healthcare, they're all defensive. They're about protection. And protection is critical when you're over 60 with under $500,000, but defense alone isn't enough. Which brings us to the next principle. This is the insight that separates merely surviving retirement from thriving in it. You still need growth, but you need it from the right sources. Here's what I mean. At 60 with $400,000, if you go fully defensive and put everything in cash or short-term bonds, you're protecting against market crashes, but you're guaranteeing purchasing power erosion. Over 25 years, inflation will cut your purchasing power in half, even at just 3% annual inflation. You need some growth, but you need it intelligently, not from taking equity risk you can't afford, from optimizing what you control. Let me show you this principle in action. In 2011, during the European debt crisis, we at Oaktree raised capital for European opportunities. Credit spreads had widened dramatically. Everyone was scared. Europe is falling apart, they said, and they were right to be concerned, but we saw opportunity, not because we thought Europe would boom, because we saw assets trading at prices that compensated us handsomely for the risks. We bought senior secured debt at 60 or 70 cents on the dollar. We weren't betting on growth, we were buying protection with upside. That's the mindset you need at 60. Not growth for growth's sake. Strategic positioning that offers protection with participation. For you, this means several things. First, optimize Social Security claiming. This is the closest thing to a guaranteed return you'll ever find. A married couple can add $100,000 or more to lifetime benefits through optimal claiming strategies. That's real money. That's growth without market risk. Second, consider dividend-focused equity positions for your growth allocation. Not chasing yield. Quality companies with sustainable dividends, strong balance sheets, histories of dividend growth. These provide income that tends to grow with inflation while offering some equity upside. More importantly, dividends are less volatile than stock prices. You can maintain income even when prices fluctuate. Third, look at I-bonds for a portion of your fixed income allocation. They're inflation protected. They're government guaranteed. They're boring. They're perfect for the defensive portion of a retirement portfolio. You can only buy $10,000 per person per year, but over several years, that becomes meaningful. Fourth, if you have a mortgage, run the numbers on paying it off versus investing. The math varies by interest rate and tax situation, but the psychological benefit of eliminating your largest fixed expense often outweighs the pure financial calculation. Having no mortgage payment gives you flexibility that's hard to quantify, but enormously valuable. This isn't about chasing returns. It's about intelligent optimization of what you control. Social Security timing, dividend quality, inflation protection, expense reduction, these decisions compound over 25 years into differences of hundreds of thousands of dollars. Now, here's the second-level insight. First-level thinking says, I need 7% returns to make my plan work. Second-level thinking asks, can I optimize my plan to work with 5% returns while protecting against the downside? And when you ask that question, you realize the answer is often yes through the strategies I've just outlined. This is what keeps you wealthy through multiple market cycles. Not brilliance, not luck. Intelligent risk management combined with strategic optimization. The specifics matter here. Let me give you the framework we use for evaluating opportunities. Before every investment decision, we ask, what's the downside? What's the probability of the downside? What's the upside? What's the probability of the upside? How does this fit our overall portfolio? What's our edge in making this investment? You should ask similar questions. Before any major financial decision after 60, ask, what's the worst case? Can I survive the worst case? What's the best case? Do I need the best case to succeed? If markets decline 30%, how does this decision look? If I'm wrong, can I recover? This discipline, applied consistently, protects you from the catastrophic mistakes that destroy retirement plans. It won't optimize every decision, but it will prevent the disasters. Now let me show you how these four principles work together, because there's one more insight that ties everything together. Remember the man in my office in 2007? He violated every principle I've just outlined. He didn't understand sequence risk, so he maintained aggressive positioning late in the cycle. He wasn't flexible, so he couldn't adjust when markets crashed. He'd underestimated healthcare costs. He hadn't optimized Social Security. He wasn't asking the right questions about risk. If he had understood these principles, he would have reduced equity exposure in 2006 and 2007. He would have built a larger cash reserve. He would have delayed retirement by 2 years, working through the crisis while stocks were down, then retiring in 2010 when markets had recovered. He would have delayed Social Security to 66 or 67, increasing his guaranteed income. He would have researched healthcare costs and planned accordingly. That alternative path would have changed everything. He'd have retired on schedule or close to it. He'd have more money now. He'd have less stress. Not because he was smarter or luckier, because he understood principles that most people learn too late. This isn't hindsight bias, this is pattern recognition. The same patterns that destroyed retirement plans in 2000 to 2002, in 2008 to 2009, in 2022. The same patterns that will matter in the next bear market whenever it comes. And here's what concerns me. I'm seeing some of these same patterns right now. Not identical to 2007, history doesn't repeat, it rhymes, but the rhythm is familiar. Valuations are elevated, credit spreads are tight. Investor sentiment is optimistic. These aren't predictions, they're observations. I don't know what happens next, but I know that defensive positioning for someone over 60 with under $500,000 makes sense regardless of what happens next. Because here's the ultimate insight. At your age, with your savings level, asymmetry matters more than anything else. The damage from being wrong defensively, missing some upside, is manageable. The damage from being wrong aggressively, experiencing a major bear market early in retirement, is catastrophic. This is second-level thinking. This is cycle awareness. This is risk management. This is what keeps retirement plans intact through market cycles. So, how do you actually implement this? Let me give you the specific framework I'd use if I were 60 with $450,000 saved. Before every major financial decision, I'd ask, does this increase or decrease my flexibility? Does this protect against sequence risk? Have I accounted for healthcare costs? Am I optimizing guaranteed income? What's the downside scenario? If I couldn't answer yes to most of these, I wouldn't proceed. And here's what I'd do in the next 6 months. Calculate exact fixed expenses versus guaranteed income. If there's a gap, make a plan to close it through delayed Social Security, part-time work, or expense reduction. Build or maintain a cash reserve equal to 3 years of expenses, if possible. Review equity allocation. If it's above 50% and I'm within 5 years of retirement, I'd consider reducing it. Research healthcare costs and Medicare options thoroughly. Maximize HSA contributions if still working. Track these metrics going forward. Portfolio balance relative to spending. Withdrawal rate as percentage of portfolio. Equity allocation. Cash reserve in months of expenses. Fixed expenses versus guaranteed income gap. This isn't sexy, this isn't exciting, but it works. And working is better than exciting when you're managing the most critical financial phase of your life. That's where we started. A man in my office in 2007 who didn't understand these principles. Now you understand what he didn't. Now you have the framework he lacked. The question is, will you use it? Because here's the reality. Most people will read this, nod along, and change nothing. They'll go back to hoping markets cooperate. They'll make the same mistakes. They'll get the same results. Don't be most people. Before you go to bed tonight, calculate your fixed expenses and compare them to your guaranteed income. Write down the number. That gap is your vulnerability. That's what you need to address. That's your first step. And subscribe if you haven't already, because this channel is about risk management and second-level thinking, the kind of thinking that protects wealth when protection matters most. Over 60 with under $500,000 isn't a crisis. It's a challenge. But it's a solvable challenge if you understand the principles, if you respect sequence risk, if you build flexibility, if you plan for healthcare, if you optimize intelligently, if you think asymmetrically. That's what 50 years of investing teaches you. That's what surviving multiple market cycles shows you. That's what managing billions through crises proves. These principles work. They worked in 2000. They worked in 2008. They'll work in the next crisis, but only if you implement them. I can't do it for you. I can only show you how. The rest is up to you.